Warren Buffett probably comes up with more wisdom in terms of the approach he takes to investments than anybody else. So every year he has his annual meeting in Omaha, Nebraska, and he came up with 5 rules for investing at his last meeting, which I think were very insightful. So the first rule is you don't need to be an expert. You can keep things simple. Fundamentals are what drive returns on investments. He said, focus on the productivity of the asset that you're buying. By that he means, if you were out buying an apartment building, you should focus on what it takes to get the rental income on the apartment building up, the quality of the building up. Focus on making that asset productive and having it increase in its ability to generate cash flow. Because if you do pay attention to that, you never have to worry about the price, which is his third rule. Don't focus on price. That's just pure speculation. This is a lot harder to do. Intellectualizing this is quite easy. But basically, everybody focuses on price. And it's very hard to remove yourself from that. Focus on the playing field. That is the game, as opposed to the scoreboard. And you know all these sports metaphors that people have. But basically, coaches tell players, if you want to win, you can't be looking at the scoreboard. And finally, he says, listening to macro opinions or market predictions is a waste of time. So I hate to say this, but tonight, according to Warren, this really would be a waste of time. So we're going to try to see if we can turn that around at least a little bit. Let's talk about interest rates. In the last 60 years, buying corporate bonds has been a reasonable investment, generating about a 3.4% rate of return after inflation, which is what historically you would hope for from basically lending somebody money. But that's made up of 2 periods of time. The first 31 years, the rates of return were actually almost negative. Well, in real terms, they were negative. And then there was a huge bull market, which has just recently ended with respect to bonds, where returns were absolutely outsized, in many cases outperforming many equity markets around the world. So when things turn, they can turn for a very long time. And I don't know where interest rates are going to head. This is a projection of interest rates for the last 150 years. Are we going back to 1981, 18% interest rates, or 1961, 5 or 6% interest rates? I think our view is it's more likely to be 61 than 81, but regardless, it's going to be a period of time at some point when rates are higher than they are today. So let's start with a bit of a case study. So this is a woman, we'll make up her name, Gladys Byron. She is earning about $120,000 a year of income. Conservative investor, she gives about $10,000 a year to various charities. She has $500,000 in term deposits, and they were at 4%. Now they're going to renew at 2.2%. A few years ago, she was getting almost 6% on those term deposits. She wants to leave some capital to a particular charity in her will, and she's concerned, for good reason, with her cash flow from her investments, because she doesn't really want to step up and take greater risk. So in the last 20 years, she's gone from 11.5 to 5.5 to 2.2. This period of time is likely over, but again, as Rob suggested, we might be waiting a long time to get back to anything like 5, 6, 7% GIC rates. So let's look at the cash flow differences. Her capital she invested is $500,000. The interest rates are lower today. The income is lower. Obviously, the tax is lower, but the net income is 60% less than it was in 2000. So that's a huge drop, because obviously there's been some inflation since 2000 to today. So from her perspective, this is a very significant drop. So one choice she has is to go out and see if she qualifies to acquire an insured annuity. So she gives $500,000 to one insurance company that pays her each year $22,500 of annuity income, and $4,000 of that is taxable. And then they write another check to another insurance company for $21,000 a year that insures her for $500,000 to guarantee the money will flow back into her estate, so her $500,000 will stay whole. She'll have to pay the government about $1,800 a year in taxes on this cash flow. So when we compare it to the previous arrangement with the GICs, the income, the actual effective interest rate is twice as high as a GIC would be today. But more importantly, hardly any of it is taxable, which means that her after-tax income is more than it was 15 years ago. So she's not taking any kind of significant risk here at all. The annuity and the insurance are guaranteed, but she has generated significantly more cash flow. She can actually go one more step. Earlier I said she was allocating some of her money in her will. A lot of people leave through plan giving money in their estate to a particular charity, or if they have their own foundation, to their foundation. The problem a lot of people run into, well, they don't run into it because of course they're dead, but the people their beneficiaries do, is that a bequest is made to a charity which would be tax deductible to the estate, and the estate doesn't have enough taxable income to actually use the deduction, so it doesn't get used. So an alternative for her would be to say, instead of giving $500,000 from her estate to the charity, she can just assign the insurance policy to the charity and give them that. If she does that, she will be able to deduct the premiums against her other income, and instead of actually paying tax on her annuity income, she'll get a tax refund, in this case of $7,600 a year. So when we look at the cash flow on the charitable side, everything is the same, but now we look at the taxable income. It's negative. She actually gets a deduction against her other investment income. She will end up having negative taxes on this income, more cash flow. In fact, she'll have 80% more cash flow than she would have had in 2000, and she will have 400% more income than she would have had she invested in a GIC without taking any appreciable risk at all. So these are ways to adapt or adjust to tough interest rates.